game-changing discussions on the big ideas that shape our thinking. This is One2One. Previously on One2One.
We, in 2020, acquired the hospital, Arielad Hospital. It was a 38-year-old hospital, founded and built by an amazing man, Dr. Oladipo.
Absolutely.
Absolutely amazing man with his wife. They built this thing from scratch to a mid-size. It was a 100-bed hospital. So in total, we are in 6 locations across Lagos today. We're seeing 200,000 patients a day. And within, the main head office, we've expanded capacity, we've deepened services.
Okay, so I'd like to delve a little bit further into the finance and economics of all of this. I mean, it must all be underpinned by sustainable business.
Yes.
No doubt about that. And there are those who would say that, healthcare really is a cost center. And less than 1% of global private equity funds flow into African healthcare,
yes.
Let alone, talk about Nigeria.
Yes.
So my question is, how do you go about convincing investors otherwise? Are the nuts and bolts of this problem and how you go about resolving it?
Tokunbo, it's very difficult. I have to confess, it's very, very difficult. At the beginning, I think when we started out, it was the COVID year. And I think COVID being around, sort of, when I look back now, I think it softened the ground for us a bit. People were more amenable to look at healthcare in the COVID year. So we raised a bit of money in our first 2-3 years. The real problem, Tokunbo, is the fact that in Nigeria, you cannot point to one healthcare company and say, this is the model. They're successful, they're profitable, they're paying dividends. First of all, most of the companies are tiny, as we said earlier.
Yeah.
It's a fragmented business. I think there's only one hospital that's quoted on the stock exchange. If it's still on the stock exchange, I do not remember the last time they paid dividends, et cetera, et cetera.
Yeah, that's very historical matter.
Yes. But you can point to all the banks. The banks are paying dividends twice a year.
Yeah.
So as an investor, the dollar doesn't really care. It's not a sentimental currency.
Yeah, absolutely.
It's looking for where it's going to get returns.
Yeah, doesn't know social impact, doesn't know ESG.
It doesn't. I mean, the investors will tell you that those things are important to them, but let's be honest. So the only way is to show people that in other places, other similar places, they have done the transformation.
Yeah.
And this is the road map. And in those places today, the businesses are quoted. I think Apollo is quoted in India and in Luxembourg. Mediclinic is quoted in South Africa, and I think on the London Stock Exchange. So in other parts of the world, other parts of emerging markets, people have transformed from this notion of it's just a social service into, sustainable businesses. And we have to do the same thing here. And the earlier we do it, the better.
Yeah.
But I believe once we do it and we show Nigerians that, look, healthcare it can be a business and it can be a very profitable business, then I think we will see the investments. The question is, how long is it going to take us, to do this? And how many people are on that journey? Because the more organizations are on that journey, the higher the chances of success for 1 or 2 or 3 of them. And it's that success that will start to open the door for many investors. Of course, there are a few investors who would believe in us, as the people in AfyA Care. They know what we've done, in the past. And they feel that, the story we've told them is a good story. They feel we know the roadmap, and therefore they've invested in us to finance all of these things that I've talked about. But the journey ahead is still quite long.
Yeah.
And constantly, we need to put in a bit more money. This year, for example, for us at AfyA Care, we break even on an EBITDA basis. So we're very thankful.
Good.
It's taken, I
Congratulations.
thank you very much. I think a couple of years longer than we expected, but where
It's no mean feat. It's no easy task.
No, it's not.
Well done.
No, it's not. But that's also because, of course, our people have gotten better and better at what they do. The quality of care we give is a lot better. Patient experience is a lot higher. Net promoter score has gone from negative, 2 years ago to I think about 70 today at Arielad, for example. But also because we've been able to leverage on all of this success to build bigger and bigger scale. And so we're seeing the scale effect. And the more we stay at it and we improve on the scale, we expand, then, it's only natural, to be honest, that the result will come out. If we do the things in a very disciplined manner that will bring out success, then we will get success.
Sure. Absolutely. And it is a fact that healthcare in Africa particularly requires, talking about investors,
Yes,
patient capital.
it does.
Pardon the pun.
It does. It does. It does. It does. It does. Patient capital, patient short-term, medium-term financing. We have loans, with banks that have been extremely supportive. Sterling Bank is an amazing bank, that has really given us a lot of support. And we really cannot tell our story without talking about Abubakar Suleiman and Sterling Bank and his colleagues. Most Nigerian banks wait until you're successful. Then they come and say, we'd like to bank you.
Of course. Yes, the phrase, that typical phrase, we would like to bank you.
Yeah, we'd like to bank you after you're successful. Yes. They have taken a very big, gamble. According to their own ethos, they have this thing they call the heart of, Sterling. And the very first letter in the acronym is healthcare. And they're living up to that. So we're really grateful, to these kind of organizations. We're grateful to the investors. We have a couple of private equity investors who have invested in us, Stone, Kuramo, amazing. IFC has always been a big investor in healthcare, and they're with us, and they invest not just capital, but also human capital.
Yes.
So they've helped us a lot with the transformation, with raising quality. So we're really grateful, to the investors, we have.
Yeah, no, absolutely. So, yeah, we would like to bank you. I wonder how many times you said that in your career in banking.
Many times. I confess, guilty as charged.
Okay, so you've just talked really about a mix. We started out talking about patient, long-term capital. You've talked about the support you've had from Sterling Bank. But you've also talked very quickly there about DFIs, and you've talked about IFC and one or two others have gone in there. So my question here is, in your view, what's the right balance, that will support healthcare? The right balance between patient capital or private capital, government support, donor funding, and DFI support. Where is that sweet spot?
So from my experience, and this is not my first experience in raising capital, in 2011, when GT Bank had to exit the insurance business that we were building because central bank regulations had changed and banks were no longer allowed to invest, in non-banking businesses, we had to go around the world, and we raised capital from private equity and DFIs. And it was a very deliberate strategy at that time. The DFIs will bring maybe just a little bit of money, not as much money as the private equity firms, but they would bring patience. They would bring some structure. They would help a bit more with the corporate governance. And having them on your equity list also helps even with your sales efforts when you're chasing up on large institutional, customers, etc. But the private equity firms are excellent in the sense that they keep you on your toes.
Yes, of course.
When you have the guys, they're not exactly cracking the whip, but the whip is there.
Oh, well, we are Tosin, they're cracking the whip. There's no doubt about this. We're cracking them in.
Well, you know the whip is there. You know that these guys, they themselves have collected money from other investors, and
of course. And there's quite often a lot of DFI money in private equity.
There is.
Actually, by the way.
There is, especially in Africa.
Yes.
Actually, quite a lot of private equity fund in Africa is from DFIs.
That's right.
So they keep you on your toes. They ask business questions, and they do business analysis with you. They test your theories. They make you test your own assumptions. And therefore, you probably get better at your craft. You get better at the business. And, you grow a little bit quicker than you may have grown if you had only DFIs in the business. So for me, I think, honestly, that balance is extremely good. If you throw in some family offices in there, not bad, even though family offices, my experience, tend not to invest a lot, in private ventures in Nigeria. And then the issue comes with short-term funding and banks. And I think that in healthcare, you have to limit bank loans. And especially at any time when interest rates are above 15%.
And what are we talking about in this country? With 25 thereabouts, but BOI would give you.
BOI is excellent. Excellent. I'm so sorry, I forgot to mention BOI. BOI has been supportive. Thank you for bringing that up. If they watch this interview, they're happy with me. BOI has been excellent. They've been supportive of our business, and we're very grateful to them. And they help us to dilute our cost of funding because, they give us money 10, 9, 10, 11%, I think some 15% now. But pure commercial loans today, they range from 33% to 35%. You're going to die. You're going to die.
It's not sustainable.
It's not sustainable.
It's not compatible with any business. In my view.
No, because the rule of the thumb is that if your EBITDA margin is less than your cost of borrowing, then you're destroying value.
Of course.
But you sometimes don't have a choice because you also need to expand and grow scale quickly. So you take the gamble and you go for the commercial, facility, but you need to raise capital as quickly as possible and pay it down. My own thoughts today are that commercial loans a hospital should avoid taking commercial loans for anything longer than, I would say, maybe 9 months. Because you're just going to end up destroying the value. So you need to raise equity and you need to raise concessionary funding from DFIs and then stay away from commercial loans if you can.
Absolutely.
For the medium to long term.
Yeah. So that leads me on, and then we've started talking about the question of affordability, structure, systemic issues in Nigerian healthcare. In your view, what are the biggest structural constraints that keep Nigeria's healthcare from developing and scaling effectively? So
I think I started that with my earlier submission on. I think there are two things. The health insurance, I think, is primary. If we can get health insurance penetration up to 50%, that will free up some financing, for the providers. But I think the providers need to restructure. This fragmented system cannot scale. Every doctor wants to be managing director, chief executive officer, chief medical director of their 10-bed, 15-bed hospital. It doesn't work.
And they want to see patients too.
It doesn't work. So we need to build consolidated entities, stronger, larger, that can benefit from economies of scale and wring out some positive EBITDA figures from the scale of operations, because it's that profitability that will become enticing to the investors and to the lenders.
Sure.
So you need scale to deliver some level of profitability. 10% EBITDA margin, 15% EBITDA margin is a good starting point.
Absolutely.
Once you have that, then the bankers can sit with you. The investors can sit with you and say, we project we can lend safely to you and you return our money in 3 years. The investors can come and invest and say, we project we can invest in you and in 5 years we will go out at 2x or at 3x. So the starting point is for these hospitals to come together. I've attended quite a few, conferences, and people like to invite me to come and speak on healthcare finance. I preach the same message all the time, and I tell them you don't need to join AfyA Care. So this is not a pitch for you to join AfyA Care. You can form yourselves together, but the only way you're going to really develop, long-lasting institutions is by building bigger organizations.
Federation.
Yeah. We use whatever model suits you, but they've got to be big. Think about Nigeria. Think about Nigeria having 43,000 community banks, no single merchant bank, no single commercial bank. So no GT Bank, no UBA, no Zenith, no First Bank. What would be this landscape? What would it look like?
Absolutely.
Mayhem.
Yeah, absolutely.
Absolute mayhem.
Yeah.
When I started banking in 1992, there were 120 banks.
Yeah.
And it was mayhem. It was disastrous.
Yeah.
People were gaming the system. The regulatory, bodies could not keep up with the games, of the players. It was all about round tripping ethics, etc., etc. Quality wasn't good. They could not finance anything reasonable. Today, Mr. Soludo brought everything down.
Of course. Consolidation.
To 24, 25 banks through consolidation. And the changes were immediate.
Absolutely.
Capacity, durability of the organizations, quality of service, innovation, everything went up. Everything. Ability to finance, large structures like Dangote Cement, Obajana, Ibeshe, Nigerian banks were present, with the finance, and those are country-changing, transactions.
Absolutely.
Nation-changing, nation-transforming transactions.
Speaks to infrastructure.
It speaks to infrastructure, the kind of infrastructure the government can never do. I don't know how much of Nigerian bank loans were in Dangote Refinery, for example, but that's another nation, maybe continent transforming investment. So for us to get something similar in healthcare, we have to build 4-5 large institutions. Each one of them 5,000 beds, 10,000 beds, 20 hospitals across the country, 30 hospitals across the country, all connected with technologies, high standards. They have internal control, they have internal audit, they have clinical control, and all of those functions that actually make the standards of a hospital high. It's the same Nigerian doctors who are here who go abroad. The difference is that they're going into systems there where those control functions are there because the hospitals are large. They can afford to pay this group of people who are just looking after standards and quality.
Yeah.
When you're 15 bed, you can hardly even afford to pay the doctors that are seeing patients. Not talk of affording to pay doctors or affording to pay people who are going to do all these extra functions.
The economies of scale are not there.
Economies of scale are not there. Economies of scale are not there. You're going to be buying medicine from people who are bought, from people who are bought, from people who are brought. When you have economies of scale, you walk into Fitsin and you say, dear Dr. Ayebe, please, would like to order medicine for the next 1 year. And, you cut your deal straight with the manufacturer.
Exactly.
And it's a rock bottom price. And therefore, you can pass on some of the savings to the patients. And then you can pass on some of the savings to your investors.
Yeah.
And the business becomes sustainable.
Absolutely. I think we're at a perfect point in this conversation to talk about, of course, you are at the intersection of finance, leadership, social impact. We've talked about all of those things in this conversation. So I'm going to ask you a pointed question, especially coming from a background in finance. How do you reconcile profit with the essential purpose of your endeavor, which is to deliver high quality care?
Honestly, I think it's a lot simpler than people think, and they are totally interrelated. Impact for me is making good health care available to people who ordinarily wouldn't have it. The options they would have would be very limiting, and the quality of care they would get would be very restricted. In the AfyA Care model, we are delivering very good care to people at bottom prices. One of our investors was asking us this question one day, and we converted our rates to dollars, for them to see. People are seeing doctors and they're paying $3, they're paying $5 to see consultants. You know how much people charge in the rest of the world just to see doctors, to get a bed overnight. In our Arielad standard is less than $10. So we know that we're bringing that care to people, but we also know that we cannot deliver that profit unless we do that much more, unless we actually expand that scale much more. Our focus is not the 1% of 1%. We're not interested in that market at all. We're interested in the lower income and the lower middle income at Arielad. We're building a second hospital company that is entirely focused on the middle income class. That's the Oakwood Medical Center. We'll open next year. Fingers crossed.
It is wood. It's magnet wood.
So for us, it's important that we are able to deliver that care and to save lives and to do it at affordable prices. And for as long as we do that and we do that at the right scale, our formula says we will make money and we will deliver profit. Because we know if we don't deliver profit, our business is not sustainable. We're going to die. So we have to deliver profit, but the route to doing that is to make this service more affordable and more accessible to people.
Sure.
The bigger that is, the more profit we'll generate.
Of course. So of course you are focused on democratizing healthcare. The answer, from what you've told me, therefore, to that, delivering that affordability is scale.
Is scale.
And you are growing, expanding.
Yes.
Okay, perhaps not quite at the scale
that we want. It's limited by capital.
Absolutely. Yet you are now this year
EBITDA
positive. And logically, that is saying to me that your strategy is beginning to deliver benefits.
Yes.
My question is, what's that doing to quality? If you haven't quite reached that level of scale, prices are down, you are EBITDA positive.
Yes.
The one thing we do have to be concerned about is quality. What would you say?
Interestingly for us, the quality is going up every year. So let me tell you how we're structured. So on the clinical side, first we have a board governance committee that is chaired by one of the, I would say, revered physicians in this town, returnee of many years ago, and has been CMD in a very big, private hospital, has been managing director in a very big private hospital. He's a surgeon. I'm sure I've given you all the clues. You know who this is.
Yeah.
And he is very particular about quality and about standards. He, I think, was the first person to get a JCI accreditation for his hospital. So he has all the standards. He is a member of the Society for Quality, SQN or something.
You've named him in all
big ways. In many ways.
Yeah.
Dr. Jim Cook is an amazing person. He chairs that board.
Yeah.
And on that board also, we have, a nurse with a PhD in nursing, who works with one of the large, oil companies, again, in a facility that has, accreditation. And then, of course, we have our own team. Working with us is IFC, who we have subscribed to this global index survey that they run every 2 years. So every 2 years, they have, I think, 150, 250 hospitals across the world, mostly in emerging markets, but also some of them in Europe. And they have, some metrics that they measure, and they measure everyone. And you'll see where you are in this measure, in this particular metrics. You see where you are. We know where we were, the first time we did it. We know where we were the second time we did it. We just got the report for last year, and there is improvement.
Where are you?
Let's just say that I would say that we're probably about the 50th percentile today.
Right.
And we started from maybe lower than 75th percentile.
Right.
In some measures, we're in the 25th percentile. But on a general basis, I would say that we're now 50th percentile, moving upward all the time.
Does that give you some idea which services also need, but which services are perhaps on the 10th?
It does, because every time we review the report, we see where we're down.
Sure.
And then we work on it.
Sure.
And then it's better.
Correct. Yeah.
We work on it, and then it's better.
That's the point, isn't it?
We do root cause analysis. Wow, we have a number of theaters delivering excellent metrics on surgical infection, surgical site infection rate, and then we have this particular theater, and the rates are not so good. So we go, we check what's going on. Where's the CSSD? What does the CSSD look like? What's the process flow? Is there a dirty corridor? Is there a clean corridor? And you do the analysis, you unearth the problem, you fix the problem, and then the result, shows. So for us, Tokunbo, I promise you, quality is the one thing that I'm after in this business.
Yes.
I think if we wanted to make money, I would have gone back to banking.
Many other industries.
Yeah. But, my wife's cousin says to me, Tosin, you could have done anything. Why did you go into this healthcare business? I could have done oil and gas. I ran oil and gas in GT Bank for 2 years, so I'm quite familiar with that. But quality is the one thing that we will do. But to do that quality on a sustainable basis, you have to make profit. So there must be a balance.
Sure.
And we've seen the model elsewhere.
Yeah.
So why can't we do it?
Absolutely. So tell me, therefore, what your outlook for healthcare investment in Africa is over the next 10 years. How do you see it panning out?
Let me start with Nigeria. Because Africa is not really the same. South Africa is advanced.
So you say sub-Saharan?
Yeah, so sub-Saharan Africa. Let me start with Nigeria. I think in 10, 15 years, we will have maybe 3 to 5 large corporates owning dozens of hospitals across the country, having that scale, but also having the structure on the clinical side and having the structure on the non-clinical side, and those structures will be operating at standards that are comparable with the rest of the world. And health insurance would underpin all of this. And we will be at that 50%, health insurance, rate, penetration rate. And we would have a lot of Nigerian doctors who would follow the path you have gone, from Diaspora, come back to come and help raise the standard of care, to come and raise the standard of teaching and developing new doctors. And we would have technology. A lot of the technology may not necessarily be from the West, it may be from China, but we would have technology because of affordability. Today, open heart surgeries is probably the exclusive preserve of the 1% of 1%, putting in stents and so on, because obviously the price is high. At that time, I think, for $2,000, people will be, putting in stents, and doing all sorts of procedures, and therefore it will be democratized. And with health insurance, I think things will be a lot better.
Tosin Runsewe, thank you for joining us on
Thank you.
One2One.
Thank you.
Thank you.
Thank you.
Pleasure.